So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again at optionalpha.com, and welcome back to The Daily Call. Today we're going to do hopefully a fairly quick guide on trading volatility for or with options. I say quick guide because I don't think that there's a lot that we have to go over to get the broad strokes. There's obviously a lot more detail and a lot more deep diving that you can do on volatility trading. But I want to try to get through the broad strokes here. If you're new to options trading, or if you're even a sophisticated trader that's been around for a while, there's probably a couple key concepts that we need to cover. So the first thing with trading volatility in general is that with options, and specifically just calls or puts, however you want to think about it, we have the ability to trade volatility as a underlying asset class. Now, there's two ways we can do this. We can trade volatility in and of itself through volatility products like VIX, VXX, UVXY, etc. And we can trade the volatility of underlying securities like regular stocks and ETFs. What we prefer to do most of the time, although we trade VXX and VIX a lot, we prefer most of the time, though, to trade the underlying volatility of regular equities and ETFs. And what I mean by this is that we trade the discrepancy between the implied volatility of those options and the historical volatility or actual volatility that they see going forward. And it's no different than what insurance companies do, where they overestimate how often you might die or how often your house might burn down to the ground, or what casinos do when they play their edge in gaming. They just play it over a long period of time. We're playing the same thing. So we're trading volatility in the sense of selling high overpriced implied volatility early in the expiration cycle, with the understanding that over time, most of our positions, once we get to expiration, once we're patient enough to wait the 30 or 45 days to expiration, that our options will end up decaying in value more so than the underlying stock's move that was priced in. And therefore, we take that difference or that edge as potential profit. So that's the main way that we do it. Again, you can also play volatility with actual physical underlyings like VIX and VXX, where you're making directional bets on volatility on a broad-based scale. So most of those products are based off of the VIX or VIX futures, which is then based off of the S&P 500. So you're playing kind of like broad market volatility, which is a good way to go as long as you understand those products. We have a couple podcasts on our weekly show. We also have some video tutorials that you can check out when you search VIX or VXX on our website. That'll give you a better understanding of those instruments and how to trade them. In the case of the ETNs like VXX, UVXY, they are negatively driven. They have negative drag. So you just have to be aware of, how those products are traded and what the pricing looks like moving forward, just so you understand it before you start trading it. So hopefully this is just, again, like I said, a quick guide to how we trade volatility with options and how we use and think about conceptually trading volatility around the market. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from optionalpha.com.